And in today's session, in day 2, we are going to cover 2 other areas, which includes the foreign subsidiary, and this includes the area of the cash flow statements. Let me quickly go through the messages. Hala is saying, unfortunately, I was not able to attend both yesterday and the day before. I checked YouTube. Hala, wait for an email from the admin. They are going to send you an email tomorrow with the link to the WhatsApp group and the lecture. I shared the link on the WhatsApp group so that at least people who are there could start using those. Yes, Jessa, I'm here. T saying hi there, we are running late. Yes, T, we have just started off. Okay, Walaikum Assalam, Imran. Okay, so let's start today's session. Yes, indeed, the OneNote notes are also up. I may have forgotten to share the link. I'm going to share the link for all of the days. I'm going to share a link of the folder which where all of the OneNote sessions are going to be uploaded every day. Okay. Okay, Bongani. Hopefully today's class is going to cover your issue. Walaikum Assalam Abdullahi. Yes, I'm going to share the OneNote link on the WhatsApp group today, so you will be able to use that. Okay, so now let's start today's session with the area of foreign subsidiary. Okay, Fasiya, I'm going to share the WhatsApp group link as well. Now, when we talk about a foreign subsidiary is one of the areas which was asked in the attempt of the March as well. So when we talk about the foreign subsidiary, there are some basic workings which we need to understand. Like, let's start from the working number 1, which is going to be the net assets. Let's suppose that we are a parent and we have a subsidiary. Parent is in the dollars and subsidiary is in dinars. So what we are going to do, we are first going to prepare the working number 1 net assets in dinars. And then we're going to convert that into the local currency of the parent, which is going to be the dollars. Similarly, we are going to do the same task for the goodwill, prepare it initially in the dinars, and then subsequently convert those into the dollars. Okay, Hala is saying that the voice is not clear. Walaikum Assalam, Muhammad Lameen. Is the voice clear to all of you? Is the voice clear? Kanya is saying yes. Imran is saying very clear. Okay, a lot of yes. That's great. Okay, so a lot of yes. Thank you for the feedback. Now, mainly the important thing in the foreign subsidiary is when we prepare the net assets, when we prepare the goodwill, these two workings will initially be calculated in the foreign currency, which is going to be the dinars, and then we are going to convert that into the dollars. This will result in an exchange gain or loss, which is going to be allocated between the parent's retained earnings and the NCI. In fact, instead of that, instead of the retained earnings, we can say retranslation reserve. This is the name given to the reserve where the exchange gains and losses are recorded. So we are going to start the question because this is the topic which is going to be understood if we take it from the past papers point of view. So if I open the past papers file, yes, it is under the reserves. Okay, so this is the question that we are solving by the name of RIBI. It is one of the past paper questions of P2, but we're going to solve it from the perspective of SBR. And if we see, if we start reading the question says that the following draft financial position relates to Ribi, Hale and Zian, Hall and Zian, all publicly limited companies as at 31st May 2008. So this is the year end. If we see Ribi, this is in the $1 million. If we see Hall, it is in $1 million. If we see Zian, it is going to be million dinars. So our focus is going to be more on Zian rather than the Hall, because Hall is a local subsidiary. So there should be no confusion in that. The main area important will be for the Zian. Now, the question has given us non-current assets, property, plant, equipment, investment in Hall, and the investment in Zian, which is $30 million. So if we see, this is the value in terms of the $1 million. But as we just discussed, that the goodwill is going to be calculated in the dinar first, and then we will be converting it to the dollars. Mohammed Lamin is saying, why not starting with the requirement? Mohammed Lamin, actually the requirement is something that relates to the P2 requirement, actually, to prepare a consolidated financial position. So because this is a P2 question, that is why the requirement is from P2's perspective. And that is the reason we are not starting from the requirement, because that is what has changed in the SBR. So the concept is the same, but the requirement style has changed. SBR question will depend more on discussion, a bit of calculation, in that although the calculation can be material, but the element of calculation and theory will be a mixed one in it. So let's start reading about the first adjustment number 1, which says Ribi. Okay, we have a question. Jesse saying, what is SBR requirement for this question? Jesse, mainly the SBR requirement could be that explain why exchange gains and losses arise, calculate how, discuss how the goodwill should have been calculated. These are the types of the question that the SBR examiner asks. How the goodwill should have been calculated, what is the exchange gain or loss that should be recorded, why does it arise? These are the type of the questions we should be preparing for. Bongani is saying, so in SBR, we will never be asked to prepare a consolidated balance sheet. Yes, Bongani, we ideally should not be asked to prepare a balance sheet. We can be asked to prepare an extract of the balance sheet, or an extract of the workings, that how we calculated the goodwill or how we calculated the exchange gain or loss. Now we are reading the requirement from over here because this is what is relevant to us. The question says Robbie acquired 60% of the ordinary shares of Zian for 330 million dinars. So the question is given as the cost in terms of dinars on 1st June 2006, when Zian's retained earnings were 220 million dinars. The fair value of the net assets of Zian on 1st June 2006 was 495 million dinars. The excess of the fair value over the net assets of Hall and Zian is due to an increase in the value of non-depreciable land. So there is some adjustment relating to the non-depreciable land as well. There has been no issue in ordinary shares since acquisition and goodwill on acquisition is not impaired for either Hall or Zian. Now, when we talk about a foreign subsidiary and we are solving the question of Ribi, we should ideally start it from the working number 1, which is called the net assets. And when we are calculating net assets, we write net assets at acquisition, we write the net assets at the balance sheet date. And when we say net assets, we mean share capital, retained earnings, and maybe some part of OCE. So if I go back to the question to check these values, the question had given us the net assets to be 495 and the retained earnings to be 220 million dinar, with the cost which will be used in working number 2 to be $330 million. Apart from that, if I go upwards towards the question, I'm going to find the values at the balance sheet date. So 209 and 299 is the share capital and the retained earnings with no other reserve or other components of equity. So the share capital is 209 and retained earnings are 299 with no impact in the OCE. So we can actually even remove that. While at acquisition, the share capital was the same, 209. And the retained earnings were 220. So this will give us the carrying amount of the net assets, which was 429 and which is 508. But this does not include the fair value adjustment so far. So because the question mentioned that the fair value of the net assets was how much? It was 495. So this means 495 minus 429, 66 is the fair value adjustment being the balancing figure. And because that relates to a non-depreciable land, it is going to be the same at the balance sheet date as well. So the value at the balance sheet date is going to be 574. Now these are the values that we have so far calculated in the dinars. To convert that into dollars, we need to apply the exchange rate. And when we apply the exchange rate, we need to check what are the values in the question. So if I go to the question has given us the exchange rates in adjustment number 8. These are the ones. Harun is saying, why did we get 574? And where are we going to use that? Harun, we are going to use that in the calculation of exchange gains and losses. So now the question had given us the rate of 11 at the date of acquisition and the rate of 12 at the balance sheet date. So if I go back to the question, I'm going to use 11 and 12 in my calculation. Yes, Ahmed Masih, the recording is going to be available on the YouTube. So we are going to divide it by 11 and divide it by the 12 at the date of acquisition and the balance sheet date, so that we get the values being converted into the dollars. So now if I use a calculator, I'm going to say it's 495 divided by 11. So this will give us the value of $45 million. Yes, Kashifa, it's not yet uploaded, but these will be uploaded on the YouTube as well. So 574 divided by 12 is going to give us a value of 47.8, we can say. So I'm taking it to one decimal place. This means the net assets have increased by $2.8 million, in which 60% belongs to the parent. Let me check the percentage as well. Yes, 60% belongs to the parent. And remaining 40% belongs to the NCI. So we can say 2.8 into 60% should be 1.68, which we can say 1.7 to make it one decimal place. And 2.8 into 40% is going to be 1.1. So this is how we have actually divided the share of the parent and the NCI. Is it clear so far how we calculated the working one net assets? And this 2.8 is going to be called post-acquisition profit. Yes, exactly, T. This 2.8 is called the post-acquisition profit. And 1.7 is the share of parent. And 1.1 is the share of NCI in the post-acquisition profits. Amandabi is saying the 66 adjustment is not clear. Amandabi, what is the confusion in that? The 66 is basically the balancing figure. The question mentioned us about 495 The question had mentioned about 495. So we use these as the fair value. 209 was the amount of the 209 was the amount of the share capital, and the value of the retained earnings was 220. So we added 209 in 209 in 220, and we got the carrying amount. This is the carrying amount of the net assets, while the fair value mentioned by the question was 495. So 66 became the balancing figure to us. Getting this, Ahmed Nabi? Yes, Ahmed Nabi, this 66 is in dinars, and when we actually converted 495, 495 was in dinars. This is also in dinars. When we converted into divided by 11, we got the value in terms of dollars. So because 66 was included in 495, so this means the impact of 66 in terms of dollars is included in 45 as well. Getting this, Ahmed Nabi? Yes, exactly, Mohammed Lamin. In case of plant, we would have depreciated that, which would have changed the value of this 66 into after depreciation amount. Harun is saying, please correct me if I'm wrong, 66 was not calculated for at acquisition. That is why it is transferred to get the net assets at the year end. No, Harun. 66 is what we got at acquisition. And because it was a non-depreciable land, this value. Because it was a non-depreciable land, that is why without depreciating, we used the same 66 in the balance sheet date as well. So the value is the same because there's no depreciation. Getting this, Harun? Okay, that's good. Harun has got it. Ahmad Masih is saying, what about impact of the profits? Are we not supposed to translate profits and average rate? Yes, we are going to do that, Muhammad Masih. And a difficult name, Mwaba, is saying, is there an exchange gain or loss in the net assets working? Yes, there is. We're going to calculate that, but before that, we're going to check the working number 2. And then we're going to calculate the value of the exchange gain or loss altogether. T is saying, sorry, just a little off topic. When do we use average exchange rate? T, I'm going to tell this in a while because I haven't used the average rate yet. So I'm going to explain when I'm using that actually. Okay. So let's solve working number 2, which is going to be the goodwill. Now, when we talk about the goodwill, we keep the cost, the fair value of NCI, and then we deduct the fair value of net assets. Now, because this is an old question, that is why the fair value of NCI was not given into it. But there should be a fair value of NCI in the question ID. So let's solve this using the partial goodwill method right now. Or let's assume a fair value of NCI because full goodwill is something which is more important from SBR's perspective. So the cost was given at 330 million dinars in the question. Let's assume the fair value of NCI to be 220 million dinars. We are assuming this. Let me write assuming. So if we add 220, the value is going to be 550. And the net assets at the date of acquisition were actually how much? 495. So we should be deducting 495 from this to get the goodwill of $55 million. But this is the goodwill that we would have calculated at the date of acquisition. This is the goodwill that we have calculated at acquisition. Now let's assume that 20% goodwill was actually impaired by the year end, because we need to understand the impact of the impairment as well. So if 20% of the goodwill was impaired, this means 11 of the goodwill was impaired and the remaining amount was 44. And again, these values are in terms of dinars. So we need to apply the exchange rate onto this to convert these values into dollars. And again, we are going to use two different rates because the goodwill at acquisition was different and goodwill at the balance sheet is different. At the balance sheet, the goodwill is now 44 after the impairment. So 55 divided by 11, the goodwill is going to be 5 at the date of acquisition. But by the balance sheet date, the goodwill reduced to 44 divided by 12, which is going to be $3.7 million. So this means again, there's a change in the goodwill, which is a negative $1.3 million. And out of this $1.3 million, again, parent has a 60% share and NCI has a share of 40%. So 1.3 into 60% will give us a value of 0.8. So 0.8 of the loss belongs to parent, 0.5 of the loss belongs to NCI. So this is how we calculate the net assets and the goodwill. And right now we have not calculated the exchange gain or loss yet. And the next step is what is going to be the exchange gain or loss. Yes, exactly. Parent share goes to the reserves and NCI shares goes to the NCI. Okay, Galaxy S9 is saying, I'm sure I've missed a lot, having difficulty to log on. Okay, Galaxy, I'm sorry for that. You had some difficult time. But I think the login process was simple. We had a link, the email. You simply click that and you log in. Okay, it's logged. That's good. So now the next step that we are going to solve is going to be the value of the exchange gain or loss. So now the next step is one of the most important steps and a more difficult one. Sam is asking, are these questions of SBR type? Sam, yes, these are SBR type questions, although this is a P21. But in the recent attempts of March 2019, we had a question of Carbees, which was a more detailed than the one we are right now solving. It was even more difficult than that. So these are SBR type questions for sure. Now the next step is to calculate the exchange gain or loss. For that, I'm making a working, which we can say working number 5. Now let's say if we discuss about this 2.8, is this 2.8 because of the profits or because of the exchange gains and losses? What do you think? Is this 2.8 because of the net assets, profits, or because of the exchange rates? Yes, exactly. This is because of both. The net assets have increased from 495 to 574. So one of the reasons behind this is the increase in the net assets, which was actually 79. So we can say that there are two impacts. One is going to be the post-acquisition profits, and the other thing is the exchange gain or loss. So we can say 2.8 is the total of these. Ahmad Nabi saying we didn't have such questions in kit. Ahmad Nabi, Ribi is one of the questions of the exam kit. It's there in the PPP mock mock exam number 2. So the question that we are just solving has been used in the BPP exam kit as question 2, and similar but more difficult question was there in March 2019. I'm not sure whether it is there in the exam kit or not. These have been part of the course since ever. So you can even try mock exam 2 of BPP question number 1. That's exactly the question that we are right now solving, and it may have some changes in the values, but more or less the question's concepts are the same. Okay, T, I think we are clear on the voice. So if you're having difficulty to hear the voice properly, you can rejoin the session to resolve that issue. Now, we were discussing that 2.8 of the profit is the total one. This includes the share of the parent, this includes the share of the NCI, this includes the impact of the post-acquisition profits, and this includes the impact of the exchange gain or loss. And I will answer your question in a while. Now, the parent's share in total is 1.7 and NCI's share in total is 1.1. So we have simply used these three values, 2.8, 1.7 and 1.1 to keep it over here. Because all these three values includes the profits and the exchange gain or loss. Now, how do we calculate the breakup? Even if we get any one of these two, we can calculate the other value as the balancing simply. Even if we get any one of these two, we can simply get the balancing figure as the other one. So we actually calculate the profit in actual, which was 79. Exactly, Hanan. So the value between 495 and 574 was 79. We are going to divide this with the average rate to calculate the value of the profit in terms of the dollar. So when do we use the average rate and when do we use the closing rate? The answer is simple. Anything which goes to the balance sheet, we are going to use the closing rate. And anything which goes to the income statement, we are going to use the average rate. And anything that belongs to the date of acquisition, in that case, we are going to use the rate at acquisition. So we can say all of the for the year items are going to be translated at the average rate, and all of the as at items will be translated at the rate at the date of that transaction. That's simple. Anything that goes to P&L, use the average rate. Anything that goes to the balance sheet, use the rate at the transaction date initially, but at the end, we have to bring everything in the balance sheet at the closing rate. So initially, we use the date of acquisition rate, but subsequently, we bring everything at the closing rate. Like we did for the Goodwill. We calculated it at the acquisition rate, and then we translated it back to the balance sheet date rate. Is it clear? Okay, Mohammed Lamin is saying, please check the exchange rate working at the year end. Mohammed Lamin, if there's any error in the calculation, you can tell directly. Let me check, it's 209. Plus 299 plus 66 divided by 12. It's 47.8, Mohammed Lamin. If Rahim is saying, is it okay to refer the rate at acquisition as the opening rate? Not exactly, Rahim. Opening rate means the rate at the start. Opening rate means the rate at the start. Closing rate means the rate at the end. And in my question, the question that we are solving right now, the subsidiary was acquired 2 years ago. So we can call this a historic rate. So 11 was at the date of acquisition, 12 is the closing. And if I go back to the question to check one more rate, I'm going to say that 10 is the opening rate actually. We call 10 as the opening rate, 11 as the date of acquisition rate. Okay, there's some internet connectivity issue at my end. Just give me a minute to restore on my laptop. There's some internet connectivity issue at my end. Just give me a minute. Okay, so yes, we are back now, and I hope you can see the screen back. So we were discussing that we need to check the average rate from the question. If I go back to the question, the average rate given in the question was 10.5. This is the average rate given by the question. So if we divide this 79 by 10.5, we are going to get the value of the profits. So it's 79 divided by 10.5, which is going to be 7.5 approximately. So 7.5 is the value of the post-acquisition profit in terms of the dollars. And 7.5 into 60% is what belongs to the parent, which is going to be 4.5. And 7.5 into 40% is what belongs to the NCI, which is going to be 3. So this is how we identify the actual profit and the parents and the NCI's share in that. Randolph is saying, sir, what if there are more than one average rates given in the question? Let me tell you this, Randolph, in a while, once I calculate this working. So now because we have got one value of all of these, now it's simple to calculate the other as the simple balancing figure. So if I calculate the balancing figure, 7.5 minus 2.8 would be 4.7. So 4.7 is the exchange loss. Thank you, Sophia. And again, 4.7 into 60% is what belongs to the parent, which is 2.8 negative, and 4.7 into 40% is what belongs to the NCI, which is going to be 1.9. So this is how we simply calculate the value of the exchange gains and losses. Now, this 4.7, the total value will go to the other comprehensive income in the statement of comprehensive income. Thank you, Sophia. Okay, Bibi Fatma is asking, where did we get 4.7 from? Bibi Fatma, 4.7 is the balancing figure, 7.5 minus 2.8. 7.5 this value minus 2.8 this value. So the difference is the exchange gain or loss. So now when we talk about OCI, we say that the total gain or loss should go to the OCI irrespective of what belongs to parent and what belongs to NCI. But when we talk about the balance sheet, this is what will go to the retranslation reserve. The parent's share will go to the translation reserve and the NCI's share will go to the working of the NCI. But from NCI's perspective, both the values, either it's because of the profit or the exchange gain or loss, both goes to OCI. But from parents' point of view, 4.7 will go to the retained earnings, 4.5 will go to the retained earnings, and 2.8 will go to the retranslation reserve. So the reserves of the parent is different, but that of the NCI is the same. So this is a working which can exactly tell us what should go where and what belongs to whom. It's a simple and an easy working, just a connection of the working number one. Is this clear to everyone? Because after this, we are going to solve a similar working for the working to Goodwill as well. So if there's any confusion so far, you can ask. Cindy saying, sir, NCI sticks to NCI. Yes, exactly, Cindy. Anything that belongs to NCI will go to NCI. Yes, Ahmadabi, the translation reserve will actually go to OCE. OCE means all other reserves other than the share capital and the retained earnings. All remaining things go to the OCE. Okay, now let's do a similar working for the working to Goodwill as well. Zahira is saying the NCI figures are not accounted in parents' account, right? Zahira, the NCI is recorded in the parents' books, but that's sort of a balancing figure. We are not trying to do the accounting for the NCI, but without that, our balance sheet would not balance. Ahmad Nabi, I'm going to zoom out once I complete the working for the Goodwill as well. Then you can simply take a single snapshot, which includes all of the workings. Hina is saying if I get solid on these workings and the reason behind, can I get reasonable marks? Exactly, Hina. Because in the foreign subsidiary, the main working is working 1 and 2. Because working 3 and 4 will derive from working 1 and 2. So the essence, the heart of foreign subsidiary are these two workings. Now let's solve a similar working for the goodwill as well, because in this again, there are two reasons of this 1.3. The 1.3 has two reasons. One is the impairment and the other is the exchange rate. So the impact of the impairment should go to the impact of the impairment should go to the P&L, and the remaining impact should go to the OCI. So we are writing impairment and the exchange gains and the losses. So again, the total is a negative 1.3. Then we will calculate the share of the parent and the NCI. So parent share is 0.8, NCI's share is 0.5. So only if we get any one value of the impairment or the exchange losses, we can simply calculate the other automatically. Cindy is saying, sir, after can you summarize in words for foreign exchange answer for SBR? Okay, Cindy, I will. Noor Farah is saying we need to calculate the exchange and losses on working 1 and 2 separately. Can we combine in working 5? Yes, Noor Farah, you can simply combine. Noor Farah, that you can simply combine both in a single working. That's not an issue. But I have kept it separately so that most of the people can understand it better. But you can obviously combine both of them. Okay, so now again, if we see, the value of the impairment was 11. So if I want to calculate impairment in terms of dollars, we are simply going to divide it by 10.5. Thank you, Sophia. It's 1.05. So 11 divided by 10.5 will be 1.05. We can say 1.1 in short to keep it one decimal place. So 1.1, negative 1.1 out of 1.3 is because of impairment. So remaining negative 0.2, the balancing figure, is because of the exchange gains and losses. So now if we want to calculate parents and the NCI's share, that's simple. 1.1 into 0.6, we can say 0.7, 0.4. And similarly, this will be 0.1 and 0.1. So that's how we calculated these values. And again, 0.2 is the value that will go to the OCI. 0.1 is the value that will go to the OCE. 0.7 is the value that will go to retained earning. And both of these values will go to the NCI. So that's a similar working that we just did for working number 1. We did a similar working for the working 2 as well. Okay, we have some questions. Meanwhile, I'm zooming out so that anyone who wants a snapshot can take it. Here you go. So you can take the snapshot meanwhile. Harun say, why do we take the total to OCI? Cindy, yes, it should be 0.6, 60 and 40, but because the value have to match like this as well. 0.7 and 0.1 will make 0.8, and 0.5 and 1.4 and 0.1 will make 0.5. So actually this is because of the rounding off. Otherwise the value would have been similar. T is saying, suppose there was no impairment, how would we deal with the exchange differences? Same T, if there was no impairment, this means this is directly the total exchange gains and loss. This belongs to parent, this belongs to NCI. So these three would have been the values relevant to us in that case, if there was no impairment. Okay, Harun is saying, shouldn't we take only the parent share to OCI? No, Harun. When we're preparing the SOCI, we prepare it for both the parent and the NCI. The values are the sum of the parent and the NCI, and then later on we split it between the share of parent and the share of NCI. If you remember the format, we show the total value initially, then we divide between the shares. Yes, Randolph, I'm just coming towards your question. The next discussion is the answer to your question. Now, ideally, if I tell you the question that we just did had some mistake actually. The question that we just did actually had a mistake. The mistake was there in the exam actually. If we see, we acquired the company in 2006, but the current year end was 2008. Which means there was a year in between, which is 2007. So ideally, the question should have given two average rates, the average rate for 2007 and the average rate for 2008. And even the question should have given us the profits of both the years. So the profit of 2007 should have been divided by the average rate of 2007. And the profits of 2008 should have been divided by the average rate of 2008. So if there are two average rate given, this means there should be two different profits on which they should be applied on. But because in the question this was not available, that is why we used only a single average rate for the entire profits. So the profit that we calculated over here was 79, which is the one that belongs to both 2007 and 2008. So the profits of 79 were in total from acquisition till the balance sheet. And the average rate was only given for the current year, 10.5. So logically, that's a mistake. We should not be dividing 79 by 10.5. Rather, we should be identifying the breakup of 79 for both the years, and then we should have applied different rates for the different profits. Getting this, Randolph? Then I say, could you give us some question to practice for the exam or the name so we can print those? Hina, in terms of a foreign subsidiary, Carbies is the best question which relates to March, June 2019. That is the best question for the foreign subsidiary. Enough for foreign subsidiary, one question is enough, obviously. Hina is also saying one more thing. What is the duration of this lecture? Sorry, I just joined. Hana is asking this. Hana, the duration is 3 hours. We will take a break at 9:30 and then we will complete at 11. of my time. Here you can see the timing. It's 8:59 p.m. right now. Josie is saying parents impairment in retained earning means P&L. Exactly, Josie, retained earnings means P&L. Randall is saying yes, so in that case, should we use both the rates? Exactly, Randall, you should use both the rates. Chaumu is saying March June 19 is not available on ACCA Global. No, it is available actually. It is available over there. You can download it from ACCA Global. Even I have downloaded from over there. So I'm sure that it is available over there. Okay, so that's how we were supposed to deal with the foreign subsidiary. Now, when we talk about the way of answering, Zeddy, you will receive an email with the link to the recorded lectures. So in fact, let me show you people the question relating to the foreign subsidiary. So if I simply open accglobal.com and I go to the end, I can simply go to the past papers and go to the ACCA qualification, SBR, then we can simply go to the past exam papers and select the international variant because that is what we are discussing. And nothing happened. Choose international variant. So there's the sample paper of March, June 2019 with the answer and the question. So let's open the question. So this is March, June 2019, a sample question. In this is the question by the name of Carbies, which I was mentioning about. And the question had to say, prepare an explanatory note for the directors of Carbies which address the following issues. And then it mentioned a calculation of goodwill. So this means we are supposed to calculate the goodwill which we just did in case of Ribi. On the acquisition of Bike-Lite, which means the goodwill at the date of acquisition, and what the balance would be at 30th September 2026, immediately before the disposal of shares. So the question is asking two types of goodwill, one on the acquisition. There's no option to highlight over here. So let me open it in the Adobe XP. So we were discussing that a calculation of goodwill. So we were supposed to perform the calculation on the acquisition of Bike-Lite and at 30th September 2026. So two different goodwills the question wants us to calculate. Your answer should include a calculation of the exchange difference on goodwill, which we just did in the working number 6 for the period from this date to this date. So 5 marks were there for the calculation of the goodwill and the exchange gains and losses. So for this, there was no explanation required. It was just about the calculation. And then the question says an explanation of your calculation of goodwill and the treatment of exchange differences on goodwill in the consolidated financial statement. So this is what ideally you should be understanding how to write in the exam. So Cindy, your question was to discuss how to write in the SBR exam. So let me open the Word document. And we're going to discuss in this. No, Hannah, you will not be asked to prepare the disclosures. Okay, Cindy, I will discuss the technical articles which are necessary to be read. Ahmed Nabi saying the question seems as only one goodwill has to be calculated, a bit confusing. No, Ahmad, the question is specifically mentioning a calculation of goodwill on the acquisition of bike light, and means it's a new requirement. And means it's a new requirement. And what balance would be at 30th September 2006. So the date of acquisition was actually different in this. It says that we have paid 100 million on 1st January 20x2. So this is the date of acquisition. And the question is asking on acquisition, and which means a new requirement, 30th September 20x6, which means 4 years after the purchase date. Getting this, Ahmad, how we need to identify whenever you find and, you should actually be breaking your answer for the requirement before and for the requirement after and, because these are two different requirements in a single part. Jesse is saying, can we write at layman English? Yes, indeed. Yes, Jesse, you are exactly supposed to write it in the layman English. So the question is that an explanation of your calculation of goodwill. So if I go back to the Word document, I'm going to say that in case of foreign subsidiary, goodwill is initially calculated in the functional currency of the subsidiary, and then it is translated to the presentation currency of the parent. Using the exchange rate at the date the goodwill needs to be calculated. In case of Carbies, in fact, let's write down in case of Ribi. I'm using the question of Carbies for the question of Ribi. In case of Ribi, if I go to the OneNote, we're going to say that the goodwill was 55 in terms of dinars, then we convert it into 11. In case of Ribi, goodwill at the date of acquisition was 55 million dinars, which was converted at the historical rate to get the goodwill in dollars. However, at the year end, the goodwill shall first be impaired in its functional currency and then retranslated to the presentation currency of parent using the closing rate, which shall be presented in the statement of financial position. The impairment shall be recorded as an expense in SOCI at the average rate. Difference between the goodwill in dollars and the impairment loss in dollars is the exchange gain or loss, which should be recorded in the OCI. Parent share of that gain or loss is recorded in the translation reserve, and the share of NCI in the NCI. So this is the complete explanation of what we just did in the question. We mentioned a general rule first, And then we define that how do we calculate it in terms of the balance sheet. And then we discussed about the SOCI and how that should be taken to the balance sheet at the end. Is it clear to everyone? Can I say, can you show the NCI working as well? Yes, now I'm going to show. That's also an easy part. So if I go back to the question to solve the NCI, NCI is what we say working number 3. So the NCI will start from the fair value of NCI, which we assume to be 220 million dinars. And then we should be adding the share of profit from working 1 and the share of profit from working 2. Or we can even take from the working 5 and 6. So this is 1.1. That should go to over here. And this 0.5 should also be taken to the NCI. So positive 1.1 and negative 0.5 is the share of profit. Now we should be dividing the $220 million by the rate at the date of acquisition. And why the rate at the date of acquisition? Because the fair value of 220 was also at acquisition. So if the value is at acquisition, the rate should also be at acquisition. So the final value is going to be $20 million. So 20 million plus 1.1 minus 0.5 will give us the value of $20.6 million. So that's how we should be calculating the NCI. Yes, Hina, that will have an impact on the NCI, obviously. But now I have a question. Shouldn't we convert the fair value of NCI as well to the closing rate? Shouldn't we? As we did with the goodwill, initially translating at acquisition rate and then at the year end bringing at the closing rate. So shouldn't we bring 220 as well on the closing rate? Because so far we haven't done anything over here. What do people think on this? Okay, Usman is saying no, we shouldn't. Josie is also saying no. Okay, T is also saying no. And Harun is saying no. Bibi Fatma is saying yes. Ahmad Nabi is saying no. Hina is saying, are these in dinars? Yes, Hina, 220 million is in dinars. I've written it over here as well, dinars. Hina is saying, why is it dollars at the end? Hina, because we divided by 11. So now the value of 20 is in dollars. These values were already in dollars. So we have got a final value in dollars. Okay, a lot of people are saying, no, we shouldn't be converting it to the closing rate. What is the reason? Why shouldn't we? Why shouldn't we convert it into the closing rate? He's saying we using post-acquisition profit anyway. Ahmad Nabi is saying because each item is on specific dates. Imran is getting saying the right answer. Zaira is saying I say yes because it appears in the balance sheet. Okay, Zaira. Actually, the reason is quite great if I tell you. The value of 20.6 is already at the closing rate. the value of 20.6 is already at the closing rate. How? Now that's the question, how? And the answer is pretty simple and an interesting one. Then how do we calculate the exchange gain or loss? If I ask you, how do we calculate the exchange gain or loss? The answer is simple. The value at the closing rate minus the value at the acquisition, or we can say historic rate. This is how we calculate the exchange gain or loss, right? The value at the closing rate minus the value at the opening rate, that will give us the exchange gain or loss. So now if I take this value over there, I'm going to say the value at the closing rate is equals to the value at the historic rate. That will become a positive sign going on the opposite side, plus the exchange gain or loss. So anything which is at the historic rate, if we add the exchange gain or loss into that, that will automatically come to the closing rate. Similarly, in the case of NCI, we use the opening rate, historic rate, this one, and this 1.1 and 0.5 includes the exchange gain or loss. So this means if I add the opening rate and the exchange gain or loss, the closing value will automatically be at the closing rate. So we don't need to do anything. Getting this, everyone? So 20.6 is a value which is already at the closing rate. That is why we do not need to do anything onto it. Getting this, everyone? Okay, Zara is clear on this. Cindy saying, where was 1.1 and 0.5? Cindy, the 1.1 is this, which includes the exchange gain or loss. And 0.5 is this, which again includes the exchange gain or loss of 0.1. Getting this, Cindy? Okay, great. So this is how we were supposed to calculate the foreign subsidiary. Now the next area that we need to discuss in today's session is the statement of cash flow, which is one of the area which a lot of people feel to be challenging. Now there are some rules of the cash flow statement that needs to be remembered actually. Abdullah wants to take a snapshot. So again, let's zoom out. Here you go, Abdullah. Yes, Hannah, the videos will be uploaded on the YouTube actually, not the Vimeo. Cindy, here's the snapshot of the OneNote. You can take it. T is saying, so if we had used NCI percentage, profit 2.8, would answer be wrong? Basically, 2.8 is a value. 2.8 is a value which belongs to both the parent and the NCI. So 1.1 out of that is what belongs to NCI. Okay, so people want the snapshot of the answer as well. Here you people go, you can take the snapshot of this. Hina wants to take the snapshot of the question as well. Hina, the question will be shared, so there's no need to take the snapshot of that. Yes, Bibi Fatma, I'm going to send the WhatsApp link and the video link probably tonight after the session on email to everyone who has registered for this webinar. So you can get the link from over there and simply join. Okay, so we were discussing about the cash flow statement, or rather, let's take a break, an early break today, so that we can have the discussion in a single go on the cash flow statement. So let's take a break first. Saying, so what about my question? Your question was, can I take a snapshot of the question, please? Uh, which question do you want the snapshot of? This question? Imran, I will share the WhatsApp link on the email. So you would be receiving the email. Okay, yes. Hina is asking what ACCA papers do I teach? I actually teach the papers F7, F9, and SBR. So out of the professional, I have only one paper that I teach. So I'm more of a professional of the financial and the corporate reporting and the financial management. So reporting and management are my favorite areas. Okay, so let's take a break for 15 minutes and then continue again. Run a 5 minutes break will be too short for everyone. So a reasonable break would help you people to understand the areas. Raza, I'm not sure about the P7. Yes, Cindy, I will give you some of the recommended questions in the coming days for sure. So let's take a break and then continue in a while. Manuel, we are going to solve the cash flow statement next. Okay, everyone, welcome back after the break. And there are some questions. Yes, when the subsidiary is disposed of, it will be recycled to P&L. I'm not currently offering the revision of F9 for this attempt, but probably for the next one. Hannah is saying how to pass SBR in first attempt. Is it okay to only practice questions from half of the revision kit? I don't have time for full revision kit. Yes, exactly, Hannah. The exam kit is basically provides you an idea of how the question would be. So it's not necessary to complete the entire kit, but it is necessary to study the entire standards, cover the entire syllabus. That is important. Not the entire kit is important. Um, Muba is saying that what are the areas of consolidation which are important? The areas of step acquisition and cash flow are important for the current attempt. No, Josie, the F9 lectures are not available on the Vimeo. They are available on the ibfglobal.com. Ahmed Masih saying, so will the current issues of subject are we supposed to know in December 19? Yes, we should be knowing the sorry, the framework and the current issue for sure. Okay, so we are back from the break, Ahmed Masih. So now the area that we are starting is the statement of cash flows. As I was saying that I wanted to ask when will we discuss the associate and the standards? Rather, the accounting standards will be discussed in the next 2 days, but the accounting for the associate is something not very much technical. That is why we are not going to discuss that in this revision session. Abdullah will try to do that if we get some time. So now we are starting the statement of cash flows. In the statement of cash flows, there are three headings: cash flow from operating activities, cash flow from investing activities, and the cash flow from financing activities. So these are the three main headings that we include in the statement of cash flows. When we talk about the financing activities, this mainly belongs to the area of equity and the non-current liability. The movement in the equity and the non-current liability, which can also be called the debt, is what we are going to show in the financing activity. The investment in the non-current assets and the return on the investments is what we are going to show in the investing activity. And when we talk about the operating activities, we are going to start it from the profit, and we are going to convert that profit into cash. Plus, we are going to show the impact in the working capital in this. So working capital means current assets and the current liabilities. So this is what we are going to discuss in the cash flow from operating activities. Now the cash flow from operating activities is started from the profit before tax. We started from the PBT, and then we record and then we record the adjustments into this. Adjustment that could convert the profit into the cash. And what is the main difference between the profit and the cash? The main difference is the non-cash items. The main difference are the non-cash income and non-cash expenses. Like the depreciation is one of the non-cash expenses, we are going to add them back. Yes, amortization, impairment, all these are non-cash expenses which actually reduce our profits, but they are not affecting the cash. Similarly, the change in the provision is also something which is non-cash. So we also have to remove that, which we can say increase or decrease in provision. So decrease is an income, increase is an expense. So we are going to add back the increase and we are going to deduct the decrease in the adjustments to get converted into the cash flow from operating activities. Now, these were some of the basic adjustments. If we go a bit advanced, we're going to say the share of profit in associate is also something non-cash, although it would have been added in the profit. So we should be deducting that share of profit, and the dividend that we would have received from the associate is what we would have received in the form of cash. So that will be added in the investing activity, and the share of profit will be deducted from the operating activities. So the share of profit being reversed from the operating activities and the dividend being added in the investing activities. Yes, Ahmed Nabi, we're going to come over there. Further apart from that, if we talk about expense as per IAS 19, so the service cost component or the interest cost component is what we recognize as an expense. Although this is a non-cash expense, we do not pay the amount for that. Instead, we pay the amount of the contribution. So the service cost component should be added and the contribution should be deducted. So these are the two effects that we incorporate because of the IAS 19. Similarly, the expense as per IFRS 2, that is also a non-cash expense. That is why we are going to also add it back. So in short, we can say whatever things are non-cash should be adjusted in the operating activities. Noor Farah is saying, can you explain again the service cost? Noor Farah, when we talk about IAS 19, the current service cost, the past service cost, the gain or loss on curtailment or settlement, all these values are recorded in the service cost component as an expense. So that expense is something that we call is non-cash. So that is why we are adjusting that to remove its impact. Josie, the past service cost is already added in the service cost component. It's already added over there. T is saying the share of profit is equity accounted. Why we adjust from profit? T, because the share of profit is non-cash. And the statement that we are making right now is the cash flow statement. So our main objective is to write the values which have affected the cash flow. So we have to write the values which are affecting the cash flow. Abdullah is saying if the contribution are made by both the company and third party, which one of them have an impact on the cash flow? Abdullah, obviously the amount that belongs to both the parties is what the company would have paid to the contribution. Dulu saying I thought the contribution would be added back as it had been deducted. No, Dulu, the contribution is not deducted from the P&L. That's something which affects the cash only. So the service cost is what is being deducted from this, not the contribution. So that is why we add it back. We add the service cost component and the cash impact is what we have to deduct it from over here. Now, apart from non-cash expenses, there are some non-operating items as well, which we also need to reverse. Like, for example, if the company is earning an interest income, the interest income might be in the form of cash, but that's not an operating activity. So we deduct that interest income from the operating activities, and instead we add it in the investing activities. So whatever interest we have received is what we call is the investing activity. So there are certain items which we need to remove from the operating and instead add in the investing ones. Mohammad Lamin is saying, so all non-cash elements must be added back. Not exactly, Mohammad Lamin. All non-cash expenses will be added. All non-cash income will be deducted. Expenses will be added and the incomes will be deducted. Okay, Abdullah is saying, how about credit losses under IFRS 9? Abdullah, that is also something that we say non-cash. That is why that should also be adjusted. You know, we are coming over there in a while. So all of the incomes, Sam is saying, how is the share of associate added? It is cash. Not exactly, Sam. The share of profit is non-cash. As per IS 28, we make the entry of the share of profit as investment in associate debit and the P&L credit. So that is something non-cash. We don't have received any cash. And the cash that we receive is the amount of the dividend, for which we make an entry as the bank debit and investment in associate credit. So this is the entry of share of profit and this is the entry for the dividend. So apart from that, if we talk about the gain or loss on disposal, that is also something that we say is a non-operating activity. The gain should be deducted and the loss should be added back. So now our objective is to adjust all of the non-operating items, which might have effect on the cash flow, but are not a part of the operating activities. Similarly, even the gain on disposal of subsidiary or associate is also something which needs to be adjusted. So even if we have disposed of a subsidiary, we also need to adjust that gain or loss in the operating activities. Abdullah, that is something that we are going to discuss in the cash flow statement question that we are going to do in a while. So your question will be covered over there. Josie is saying exchange differences will affect. Yes, Josie, the exchange differences recorded in the P&L would affect. Now there's one more thing. That any gain or loss recorded in the OCI, like for example, a revaluation gain or exchange gain or loss on a foreign subsidiary, similarly, any gain or loss on the fair value through OCI item, all these are the values which would have been recorded in the OCI. The values recorded in the OCI. Will this have an impact on the cash flow statement or not? Hannah thinks that it should not affect. Hina is also saying no. Abdullah is also saying no. Ahmed Nabi is also saying no. So exactly, there is no impact of the OCI on the cash flow statements. So we simply ignore that impact while making the cash flow statement. Now, apart from that, we also record the movement in the working capital. Yes, MNW is exactly right. In this, we incorporate the increase or decrease in the inventory, where the increase in inventory will result in a cash outflow and the decrease in inventory will result in a cash inflow. Similarly, we incorporate the increase or decrease in receivables. And that's also exactly the same. The increase will be a negative value and the decrease will be a positive. Increase will be a negative value, decrease will be a positive value. And the next thing is the increase or decrease in the payables, where this time the decrease would be negative and the increase would be the positive one. No problem, Cindy. So we are going to write the working capital, the movement in the working capital after the non-cash and the non-operating items. And finally, we have to write the amount of the interest that we have paid and the tax that we have paid. So these are all the values that we are going to show in the cash flow from operating activities. So as a summary, we can say that in the cash flow from operating activities, we write the PBT, we write the adjustments where we adjust the non-cash items and the non-operating items. The expenses are added back and the income is deducted from this. And after that, we write down the movement in the working capital and then the interest paid and the tax paid. So this is the summary of the values which we classify in the cash flow from operating activities. Now, apart from that, if we go to the cash flow from investing activities, in this, the main impacts are the disposal and the acquisition of the non-current assets. So any non-current asset that we have purchased will be a cash outflow, and the disposal of the non-current asset will be a cash inflow. So these are the values which will be incorporated in the investing activities. Similarly, if we have received a government grant, which is a capital grant, then that value is also going to be added in this. Now, when we say purchase or sale of the non-current asset, this includes the purchase of property, plant, equipment, the purchase and sale of intangible assets, the purchase and sale of investment properties, the purchase and sale of financial assets, and this also includes the purchase of sale of an associate or a subsidiary. All these types of non-current assets purchased or sold will be a part of the investing activities. So any non-current asset purchased or sold amongst these will be classified as an investing activity. Now, finally, in the financing activities, we mainly have the issuance of the share capital. We have the issuance and the redemption of loan notes or the debentures or the bonds. The issuance will be positive, redemption will be negative. If the company is buying back its own shares, so that is also a cash outflow. Any repayment of lease liability is also a financing activity. Any dividends paid will also be a financing activity. And any dividends paid to NCI will also be a financing activity. This is something we're going to discuss in a while. So this is how we calculate the operating, investing, and financing activities. So if I go back over here in the summary, we adjust all these values to get the cash flow from operating activities. Then we write all of the investing activities in a new column, the sum getting in the final column. Then we write the financing activities, and again the sum going in the last column. So the operating activity plus investing plus financing will give us the total cash inflow or outflow. So we call this a net cash inflow or net cash outflow. And then we have to add the cash and cash equivalent brought down into that to get the cash and cash equivalent carried down. So this is how we actually prepare the cash flow statements. So you can take the snapshot now of the overall view of the cash flow. Yes, Cindy, we are going to discuss the acquisition and disposal of subsidiary as well. Yes, now we can be asked to prepare any of these areas, the operating, investing, or financing. Now, when we say cash and cash equivalents, what do we mean by that? The cash and cash equivalent is basically the cash, the bank overdraft, and any short-term investment, which means any investment which is going to be matured within 3 months is what is called short-term investments. So all these are what we call the cash and the cash equivalents. And now you can be asked any one of these rather than all of these. So it's most probable that any one area or part of operating, part of investing, part of financing can be asked. Now, when we discussed some advanced cases of the cash flow statements, we say that let's suppose in 2020 we had an inventory of 100 million, and in 2019 we had an inventory of 70 million. So this means simply the inventory is increasing. So we say increase in inventory should be a cash outflow of 30 million. If we are increasing from 70 to 100, we simply say that the increase in inventory is a cash outflow of $30 million. But what if I say that the parent had only one subsidiary in 2019, but during 2020, we have acquired a new subsidiary. And at acquisition, the subsidiary had an inventory of $20 million. So in the start of, so in 2019, we had an inventory of 70. In 2020, we have an inventory of 100. But during the year, we acquired a new subsidiary with an inventory of 20. Now, what do you think what the value should be of the increase or decrease in the inventory? Should it be 30, 10, or 50? Okay, so everyone is saying 10. That's very good. So what we simply do is we are going to add 20 million in the opening, and we are going to say that the 90 million should be compared to 100 million. So that's an increase in the inventory of $10 million. But let's say if the case would have been opposite, that we had two subsidiaries in the start and we had one subsidiary at the year end. Now, how would you calculate the answer? We had two subsidiaries at the start and one at the year end. Now, what will be the value of the inventory? Dilpreet is saying 50, Laura is saying 20, Hiba is saying 50, Sri is saying 50. Yes, everyone is saying 50, so that's great. This time we are going to deduct 20 million from the opening, and we are going to compare the 50 million by the 100 million, which is an increase of $50 million. So we have to check whether we have acquired a subsidiary during the year or we have deducted a subsidiary during the year. Cindy is saying, sir, why add? Cindy, what add? We have deducted 20, not added 20. Cindy, we said that if I make a simple T account, the inventory opening was 70, the inventory closing is 100 if I simply make a T account. And when we would have sold the subsidiary, the inventory of 20 million would have been credited because the subsidiary would have taken its own inventory. So now the closing is 120 and the opening was sort of 70. So this means that there's an increase of 50 million. So we can simply make a T account. If we are acquiring a subsidiary, we simply debit that. If we are disposing of a subsidiary, we simply credit that. Getting this, Cindy and Razan? Okay, great. So Cindy and Razan both are clear on this. Now the second important thing is that when we acquire a subsidiary, we pay cash. So whatever cash we have paid should be recorded in the cash flow from investing activities as a cash outflow. But let's say that we are a company, so we paid cash to acquire a subsidiary, but against that cash, we would have even received the bank balance of subsidiary as well. So the cash that we have paid is a cash outflow, but the subsidiaries bank that we have received in exchange is a sort of an inflow as well. So we simply say that in the cash flow from investing activities, this should be the cash paid minus the subsidiaries bank balance, because this is what is the net cash outflow from our financials. Similarly, if the subsidiaries bank is an overdraft, so we are going to add it back. So subsidiaries bank overdraft will be added, subsidiaries bank balance will be deducted. Yes, exactly, Imran. It's simply netting off. Moaba is saying that please repeat this area. Moaba, let's suppose that if A is acquiring a company B, so A will pay cash to company B. And in turn, all of the assets of B will now belong to A. Even the bank balance of B will belong to A. So if we have paid $100 million and subsidiaries bank balance was $20 million, so we paid 100, we got 20. We paid 100 and we got $20 million in return of the bank. So the net cash outflow from us is actually $80 million. Yes, exactly, Mohammad Lami. You have got it right. So that was the overall concept of the cash flow statements. Now let's move on to the past paper document. Where we have the question of the Western Group. So now we are starting the question of the Western Group, which has given us the statement of financial position for 2016 and 15. And after this, they have given us the profit and loss and the other comprehensive income as well. Hina is saying roughly how many questions should I practice for cash flow? Hina, roughly 2 questions. You can solve one question of the Western that we are just solving and the other question of the actual exam past paper. So 2 questions would be sufficient enough. So if we see in this question, we have a profit before tax of 83. We have a share of profit of 16, a finance cost of 23. Yes, and I will name that question in a while. So now, if we start to prepare the cash flow statement in question in the case of Western, we should ideally start from the cash flow from operating activities, write the PBT, the adjustments. In the adjustments, we have seen the finance cost and the share of profit in associate, which we should be adjusting. So if I go back to the question, these values were 23 and 16. But if we see, the question says that this is the profit for the year from the continuing operations. And there is some discontinued operation as well. So ideally, we should also be calculating the profit before tax in both of these. So when we are preparing the cash flow statement, I'm writing 183 in the bracket because I should be adding the profit before tax of the discontinued operation as well. And the finance cost is 23 with the share of profit being 16. So 23 to be added, 16 to be deducted. Now, if I see that the details of the discontinued operation is there in note 2. So for a while, if I jump onto note 2, it says that the loss from the discontinued operation in the consolidated statement of P&L and the OCI relates to Northern and can be analyzed as follows. So its own profit before tax was $6 million. Its income tax expense was 2 and the loss on disposal was 29. So ideally we should be adding 6 over here because that's the profit before tax of the discontinued operation. But what about the loss on disposal? Should we add back that loss of 29 over here? This loss of 29? Should we add this in the cash flow from operating activities or not? Okay, Imran is saying no and everyone else is saying yes. Julie is saying no. Basically, if we see, this loss is not included in the profit of 6. This loss is not included in the profit of 6. So when anything is not included in the profit, why should we remove that? Getting this point? This 29 is not deducted from the 6 that we have added. So that's why its impact is not there in the PBT. Then we should not be adding this back. But the correct treatment is that we should ideally deduct it 29 from over here and then add it back. Ideally, we should be deducting it from the PBT because ideally the PBT of the discontinued was this amount. This was the correct PBT. So it should be 6 minus 29, and because 29 is non-cash, we should be adding it back in the adjustments. Getting this, everyone? Harun is saying, sir, can you please repeat this again? Harun, basically, if I'm preparing an income statement, I have sales, cost of sales, gross profit, a lot of things, and then PBT. And the PBT is 6 after deducting the loss on disposal. So this would mean that if I'm using 6 over here, then this loss has been deducted, which is a non-cash. So I should be adding it back. So I should have been adding it back. But according to the question, the 29 is out of 6. It's deducted later. So because it is deducted later, that is why it's not deducted from 6. Then why should we add it back? And if we want to add it back, then first we should be deducting it from the 6. Only then we can add it back. Getting this, Harun? Okay, that's great. Harun and Hina has got the point. Cindy wants to view the question. Here you go, Cindy. Abdullah is saying, so if we leave it in total Abdullah, ideally the answer would be incorrect, but if I tell you the examiner answer of this attempt also left it inaccurate. It didn't incorporate it anywhere, but that's logically not the right treatment. So we should ideally be studying the exact right treatment. Exactly, Cindy. Okay. Muhammad Lamin is saying you really understand this stuff. Thank you, Muhammad Lamin. Hina is saying, is there a class tomorrow? No, Hina, the class is on Friday and Saturday now. So 2 days on consolidation done, 2 days on Friday and Saturday relating to the standards. Okay, now let's get back to the question. And let's see the adjustment number 1 now, because that is one of the difficult adjustments. Now the adjustment number 1 says that on 31st July 20x5, on 31st July 2015, Western disposed of their entire 80% equity holding. So we have sold the equity holding in Northern for cash. This means we have received cash. So this cash should go to the CFI. This cash should go to the CFI. The shares had been acquired on 31st July 2011. So we are actually selling it after 4 years for a consideration of 132 million when the fair value of net assets was 124. So 132 was the cost, adding the NCI, deducting 124 should give us the goodwill. This included fair value uplift of $16 million in relation to plant, with a remaining useful life of 8 years. So 16 million of fair value adjustment of plant divided by 8 years, this means 2 million depreciation every year. Deferred tax of 25% on the fair value adjustment was also correctly provided for in the group accounts and is included within the fair value of the net assets. So this means 16 into 25% would be 4. 4 million is the deferred tax impact, which is all included in this 124. The fair value of the NCI at acquisition was 28. So if we add 28 over here, this is going to be 160. So 160 minus 24 should be a value of 36. So this means the goodwill was 36 in actually. Now it says that goodwill calculated under full fair value method was tested annually for impairment. And at 31st January 2015, which is the previous year end, goodwill relating to Northern had been impaired by 75%. So 75% of 36 should be 27. So 27 of the goodwill was impaired. So the remaining goodwill was how much? Only 9. A goodwill impairment charge has been included within the administrative expenses for the current year but does not relate to Northern. So there is an impairment loss that does not relate to Northern in the current year. Now it says that the carrying values in the individual accounts of Northern at the disposal are listed below. If we see, these values are the carrying amounts. The fair value adjustment and subsequent deferred tax were not incorporated in the individual accounts of Northern. So this means this actually means that we should be adding 16 million in the property, plant and equipment. But because this also had a life of 8 years, we should also be depreciating that by 2 million every year. And we are selling off the subsidiary after how many years? 4 years from the acquisition. So we should be deducting 2 million depreciation for 4 years from this. So we will get a value of 88 of the property. And the net impact is actually 8. 25% of what should be the deferred tax impact, which is going to be 2. So the deferred tax liability should ideally be 8 instead of 6. So if we want to calculate the fair value of the net assets at the date of disposal, we should be using 88 and 8 instead of 80 and 6. Hannah is saying, sir, why did we add 2 million? Hannah, because 8 will also have a deferred tax impact of 25%. So this 25% of 8 will give us a value of 2. So that 2 should be added in the deferred tax. Getting this, Hannah? Okay, great. So now if we read the question further, that's all in the adjustment. Now the question didn't tell us exactly at what price have we sold the subsidiary. So if I go, Cindy is saying, sir, how come only on property, plant, equipment? You calculated 25%. Cindy, actually, the question had mentioned 16 million relates to the plant. So that is what 16 million we have added over here. So because that 16 million only relates to the plant, that is why we have only added to the PPE. Getting this, Cindy? Aman Nabi saying, on what basis 8 is considered for deferred tax? Okay, Aman Nabi, basically, the concept is quite simple. If we are calculating net assets at acquisition and at balance sheet, we are writing a fair value adjustment of 16 and 8. Because annual depreciation is 16 divided by 4 years, which is, 8 years, which will give us the depreciation of 2. For 4 years, the depreciation is 18. And the net book value will be 16 minus 8 to be 8. This is what we have got from over here. Now the deferred tax is simply 25% of these values. So the deferred tax was originally 4, but now it's only 2. So we added 8 in the PPE and 2 in the deferred tax. Getting this? Okay, good. So now we were discussing about the disposal. That the entry that we discussed for the disposal was the bank debit, NCI debit, net assets credit, goodwill credit, and the balancing figure taken to the P&L, which we know is a loss in this, a loss on disposal of 29. And goodwill we know after impairment is 9. So if we get the value of the net assets and the NCI, we can simply calculate the balancing figure as the bank. But from where do we get the net assets? The net assets is simply the sum of all these values. Because this is what the net assets are all about. So we can say 88, 88 the one, this one, plus 38, plus 23, I'm adding all these values, minus 10, minus 8, minus 2. This means the net assets at the date of disposal are 129. So we can simply keep 129 as the net assets. Getting this, everyone? We simply calculated the total of all these values. And I was saying, oh my God, if the question like this comes in exam, I will not be able to do it. I will make mistakes. Yes, you know, this is what we are trying to learn. That if such type of things come in your exam and you're doing it for the first time, then obviously you would make mistakes. But if you are solving it for the second time, then you won't do the mistake so much. So the reason behind solving these type of difficult questions is to understand the level of difficulty that might come in the exam. Cindy is saying, sir, we included cash already. Yes, Cindy, this is the entry of the disposal that we are making. And later on, we are going to adjust that cash again. Now what we need to know is the NCI. If we get the value of the NCI, we can get the balancing figure as the bank. But when we calculate NCI, we are going to use the working number 3, NCI. Yes, Cindy, we still are going to add it in the net assets because otherwise my value of NCI would be incorrect. Otherwise my value of NCI would be incorrect. So when we are solving the value of NCI, the fair value of NCI was initially 28. So we will keep 28 and then we should be adding the share of profit and we should be deducting the share of impairment loss from this. So if we calculate the share of profit, the net assets at acquisition were how much? 124. This 124. And the net assets at the disposal are 129. So this means the post acquisition profit is 5 and the NCI's share is going to be 20%, which is going to be 1 million. So 1 million is what we should be adding in 28 while calculating the NCI. Plus the impairment loss that we calculated was 27. So 27 into 20% is what belongs to the NCI. So that will be 5.4. So this means the NCI at the date of disposal is 28 plus 1 minus 5.4, which is 23.6. So 23.6 is the value of NCI that we should be keeping over here to get the balancing figure of the bank. So now we can say 129 plus 9 are on the credit side. Minus 29 minus 23.6 will give us the balancing figure of the bank. So 85.4 is what? Is the cash received from the disposal of the subsidiary. So when we are writing the cash flow from investing activities, we are going to show the disposal of subsidiary as 85.4 plus the subsidiary's bank overdraft of 2 million. So we should be adding that overdraft of 2 million to get the total value of 87.4 million. This is what was to be calculated in this adjustment actually. So a long thought process behind getting a value of the bank. Now, Cindy, if you remember, if you would have not adjusted this 2 in this 129, then the post-acquisition profit would have been incorrect. And because of that, the share of profit would be incorrect. And 23.6 would be incorrect. If 23.6 is incorrect, then 85.4 will also be incorrect. So everything was deriving from that 129. So we have to take the correct net assets despite knowing that that bank overdraft is going to be adjusted later again. If you see, we previously deducted minus 2 from over here and then we have added 2. So the net impact is 0. But still we have to do that, otherwise other values would be incorrect. Getting this, Cindy? Okay, that's good. Randolph is saying how many marks for all these? Randolph, around 5 to 7 marks would be for all this working that we have done. Siri is saying bank OD is already there in the net assets. Can you explain again, please? Yes, Siri, the bank overdraft is already there in the net assets. Through that, we got to know that the amount that we have received is 85.4. But now 85.4 is what we received, and 2 is a negative balance that we transferred to someone else. So this means that is also a sort of an inflow. A negative balance going to someone else is a type of a cash inflow for us. So that is how we use the adjustment number 1 and adjustment number 2 to prepare the cash flow so far. Now, if we quickly read adjustment number 3 as well, then again a question of Western is there in the BPP kit as well. You can try that. That is more or less the same that what we have just solved. So in adjustment 3, it says that Western purchased 40% interest in an associate for cash. So again, this should be CFI. The associate paid a dividend of $10 million in the year ended 31st January 2016. So this means the dividend from associate would be $10 million into 40% what we have received. So that is going to be $4 million shown in the CFI. And in the CFO, already we have added the share of profit into that. Now, if we want to calculate the purchase price of associate, we will have to make a T account of the associate, where we will write the brought down, we will write the carried down, we will write the purchase, we will write the share of profit, and we will write the dividend. This is the normal T account of an associate. So the dividend that we have received is 4, the profit and loss that we have recorded is 16. Now, if we write the brought down and the carried down, we can calculate bank as the balancing figure. So if I go back to the question upwards towards the balance sheet, it gave us the investment in associate as 0 at the opening and 102 at the closing. So brought down is 0, carried down is 102. So 106 minus 16, this means 90 is the amount that we would have paid to purchase an associate. So that 90 million is going to be a negative balance in the investing activities. And the disposal of subsidiary, which was 87.4, should also be added over here. So this is how we have prepared an extract of the CFI and an extract of the CFO for the adjustment number 1, 2, and 3. So this was basically the question which the PPP exam kit also incorporated. So I tried to use the past paper question to try to solve the similar question with the BPP exam kit. Okay, Siri saying, I wish there's no cash flow in December sitting, jokes apart. Yes, Siri, the cash flow is a difficult one. There's no second thought about it, but always remember that the cash flow would be difficult for everyone, not just any specific of us. So if the paper is difficult for everyone, automatically the examiner tends to give easy marks in that. So it's more easier to pass in a difficult paper rather than an easy paper. No, Ahmed Nabi, we do not consider when the subsidiary is sold, the cash flow impact will be the same. Hannah wants to see the investing activities. Hannah, here you go. You can take the snapshot of the entire working. The 6 months impact will not be there in any case. Laura is saying this is definitely worth listening to again. Yes, Laura, for sure about that. Lesigo is saying, sir, is BPP exam kit recommended? Lesigo, basically the exam kits are recommended specifically for consolidation, for sure. Laura is saying, when will these be available on IBF platform? Laura, these will be available tomorrow, inshallah. Hina wants the name of the other cash flow question. Okay, Hina, let me tell you. The question is by the name of Mues, Hina. This is the question. I've opened it. This is December 2018. And this is by the name of Mues Group. So you people can try this at home. Cindy, for you as well, the Mues Group is the next question that you should be trying. A lot of questions. Let me quickly check. Mohammad Lamin sir, would you please upload it for us today? Mohammad Lamin, I will try my best to at least provide the link because the admin will actually divide the lecture into the pieces so that people can view the area that they exactly want to view. Yes, Cindy, I'm coming towards the technical article. Yes, Abdullah, I will upload it on the YouTube as well. Ina saying, I think I tried it. It's not like the Western question. Yes, Ina, this question is a bit different, not exactly like Western, but an interesting one. Ahmad Nabi saying, if we not sold the subsidiary, then we would have consolidated the cash flow. Yes, Ahmad Nabi, obviously. So he's saying this looks simple actually. Hana, can everyone access the platform? Where is it available? Hana, actually, the students who have attempted, who have the access to the full course of SBR are the ones who have been provided the access on the ibfglobal.com. T saying, would the full cash flow be examined or extract will be tested? This is hectic stuff. T, the extracts will be extracted like the ones that we just did. Prepared a CFI extract, prepared a CFO extract. This is what should ideally be there in the SBR exam. Ghana wants to view the format. This is the format, Ghana, so you can take the snapshot, the detailed one. Julie is saying, do you have a list of questions? Yes, Julie, I do have. Gania is saying, which YouTube channel? Gania, you can find my YouTube channel by my name, Hamza Abdul Haq. There, you can even find the previous lectures of the SBR. Yes, Cindy, I will send the Zoom link today, and afterwards, tomorrow it will be available on the IBF. Harun, you can search my YouTube on YouTube channel by my name, Hamza Abdul Haq. Julie is saying Muis is more straightforward. Yes, Julie, it is straightforward, and this is one of the SBR questions, Muis. While the one that we just did was one of the T2 questions. So we actually did it because it is more difficult one. Harun, you can discuss this with me personally on the WhatsApp. Hannah saying which questions from KIT are important from consolidation. Hannah, the cash flow and the cash flow and the step acquisition are the ones which are the most important. You can even try the question of JOEY, Joey, on the exam kit. That's also a good one. Cindy saying, sir, which prepare to pass you would have covered cash flow? Cindy, I do not exactly remember because so far I've conducted a lot of prepare to pass sessions and it's very difficult for me to remember in which I did what. Okay, Kashifa, I will share the list of questions. Tulu saying this question appears to have done before. Do you have others also? Dulu, which type of questions do you want others? Amanabi wants to view the OneNote. Dulu, I think the question of Mues and Western would be enough for you people to try because the cash flow area is difficult. So because the cash flow area is difficult, so I would not prefer you people to solve one of any new questions on your own. That can be even a big disaster. Okay, Hannah is saying, can we do employee benefits tomorrow? Okay, Hannah, we will try. Amanami is saying OneNote for Western. Here you go, Amanami, OneNote for Western. Mohammad Faizan, I will share the details of day 3 later on. Hannah is saying, can we do IFRS 9 as well? Okay, Hannah, we will try our level best to focus more on the important areas. Abdullah is saying IFRS 15. Okay, Abdullah, we will discuss IFRS 15. So 19, IFRS 9 and IFRS 15 are the ones that are discussed so far. Cindy is also saying yes, IFRS 15. Okay, done. So we can actually start with IFRS 15 on the next session on day 3. Bibi Fatma is saying, can the current issues be covered? Fatma, we will try to cover the current issues, not necessarily. We cannot promise that, but I will try my level best to discuss that. T is also saying current issues is likely to come. Okay, T, I will try my level best because the areas are so many and the time is very less. So Cindy is saying about the technical articles. Yes, Cindy. Let me show the technical articles actually. So if we go on the ACCA Global website again, going on the past papers, selecting the ACCA qualification, SBR, and then we should be going towards the technical articles. So this is the technical articles where we are going. In this, the ethical issue, this one, the accounting ethics and digital age, this is the most important technical article for the current attempt. So maybe question 2 can be including some type of areas of this. So this is a must do current issue. And the second is this one, the concept of profit and loss in the OCI. These two are the new technical articles introduced in the recent months. So these 2 articles are to be done for sure in any case. Abdullah, it's difficult to predict the exam, but I will try to share some of the important areas in the last class. Yes, Ahmed Masih, I can at least share the current issues handout with you people. Mohammad Lamin is saying, really, I want to pick which standard you want to revise for us, please, sir. Mohammad Lamin, we will be discussing IFRS 15, IAS 19, and IFRS 9 on day 3. And in day 4, we can discuss IAS 12 and IFRS 13 and some of the other areas as well. The lie saying question 4 is the area which he feels to be difficult. Wes is saying, I suggest to start with current issues as IFRS 15, IFRS 16 are already available in the webinar. Okay, Wes, that's even a good advice, but let's discuss IFRS 15 because that is an important one for the current attempt as well. Law is saying, what's the second article? Law, this one and this one. Accounting ethics in digital age and concepts of profit and loss. Colin is saying that I want the current issues handout. Okay, Colin, I will share that. Yes, Julie, we will discuss the important areas at the start. So thank you, everyone. Thank you for today's session. A lot of questions and looking forward to meet you all day after tomorrow, that is on Friday. Till then, take care and Allah Hafiz.